What is going on, beautiful people? It's Joe, aka the Nomad Investor, where dividends, freedom anywhere is the goal. And today we are back with another portfolio update where I'm going to be breaking down my whole new strategy and the positions that I am looking to get into, as well as some news as usual and some things that maybe you guys want to be mindful of. So without further ado, let's dive right in. We are currently at 1,016 subscribers, so we are growing at a pretty healthy and steadily rate. And we are currently at 38 videos for the channel. I am filming the 39th video, which is also the 37th portfolio update. As you guys may have seen in my last portfolio update, I sold all of my positions on Friday at a $1,100 loss. And to be honest, I don't regret it one bit. I do regret losing money. And yes, technically, if I didn't sell, I wouldn't be losing money, but I'd be down significantly more than I currently want to be, considering what the balance of my portfolio allocations were at that time. As usual, the videos on this channel are for informational, entertainment, and educational purposes only. I am not a financial professional or advisor, and nothing here should be taken as financial, investment, or tax advice. Investing always carries risk, and those seeking financial advice should seek out a registered professional. Now, if you've been watching the channel, you know that this is my game plan and goal for growing my small portfolio from $0 to $1,000 per month in dividend income. And this is me documenting this journey. So I currently have two sources of income. One is remote work income, pretty stable, pretty consistent. And the other one is business income, which does fluctuate up and down depending on the seasonality of things. And I have committed to contributing anywhere from $300 all the way to $1,000 plus per month into my Robinhood taxable brokerage. And I'm treating this brokerage like a business with the goal of aiming for 30% plus high yield. Now, the way that I aim to achieve this is through investing primarily into high yield income ETFs, such as the ones listed here, but I'm going to cover a few more. And I am going to be having a maximum of 5 to, honestly, I need to edit this, but 5 to 7 positions. And I'm going to be alternating between anchors and satellite ETFs. This is part of the core satellite investing strategy. So if you guys want to take a look at that, there's a great video by Eugen Vasquez on his channel regarding that, or you can do your own research on Google and what have you. Really, I am going to be reinvesting the weekly or monthly dividends depending on the funds that I am invested into at the time. And I'm going to be implementing a manual drip strategy. So basically, I'll stack the dividends to purchase when the market is down versus having automatic drip set up. This helps me to get the best prices, submit limit orders, and basically not get filled at a higher order than what the current market value of that stock is. And drip plus always compounding is the portfolio growth strategy. So basically, I'll just be rinse and repeating this until my account hits $1,000 a month in dividend income. And again, fellow disclaimer, none of this is financial advice. This is strictly for entertainment purposes only. I am just some random dude on the internet who is documenting his journey. Do not follow this. None of this is advice or anything of that nature, okay? For those of you who aren't aware, these are my dividend income milestones while I grow my small portfolio. And basically, this is so I can celebrate the small wins leading up to the bigger goal along the way. Now, previously, with my old portfolio and my old allocations, I had already achieved the first and second goal, and I was actually on track to potentially reach the 6th goal. And obviously my goal for this month is to try and achieve the 3rd and 4th goal. But with me selling off my positions and having to reevaluate things, I am not even sure how things are going to look. I may only hit the 1st goal or 2nd goal again. I'm basically resetting my portfolio and starting from scratch. Now, the good part is I'm not starting from scratch capital-wise, but I am starting from scratch allocation-wise, position size-wise, and a little bit more. So I'm not really sure what this month is going to entail. And this is strictly because of my decision to pivot. But we'll go into my new strategy in a bit. But you guys can pause this if you want to see all the milestones leading up to the big goal. Now, the moment you've all been waiting for. This is my new strategy. I call this the high yield income stability strategy, or the HISS strategy. And I'm going to basically be focusing on 2 key elements. Number 1, income. And number 2, stability. So in an ideal world, you can get high yield income and growth. But in this space, high yield income ETF investing, you can't always get everything. You're going to have to sacrifice something depending on what you are aiming for. But in order to achieve this, I have to do things a certain way. As much as possible, I want to limit the amount of downside my portfolio will get hit with. And in order to do that, I have to properly balance everything here. So that's why I set these two as the goal. And obviously HYISS or HISS is the acronyms for this strategy name. So for the first allocation, I'm going to be doing 30% into stable income ETFs, such as KQQQ or QDTE or something else. Now, I know I put two very different funds, and the reason why is because KQQQ, it's a monthly pair. Monthly pairs are typically just going to be more stable than a weekly pair would. Now, that's not always the case, but typically, from my experience so far, and I'm still new to this, but that's been the case. Versus QDTE is a weekly pair, but it doesn't appreciate much in NAV. There isn't a lot of movement. However, it stays relatively stable-ish and pays out consistently. So that's why I have these two listed here. But I'm interested to your guys' feedback as always. The next 30% allocation will be into high-yield income ETFs. I'm currently eyeing CHPY. CHPY is going to be my strong core-ish play. And the reason why I'm going with it, despite it being a yield max fund, is because I looked at the data. I looked at the charts. I looked at its overall performance. I looked at the distribution rate. And I was fairly impressed with this. This wasn't something that had a lot of NAV erosion, if at all. It was actually performing fairly well for yield max. And honestly, I may be speaking out of term here because I'm still learning a lot about many different funds and stuff, but I think CHPY is probably its best performer. And of course, that's because it pays out a healthy-ish distribution, and it's also technically been growing in price, growing in NAV. The next 10% will be allocated into leverage high-yield income ETFs, and just ignore the QQQI and stuff. Basically, these will be positions like HOOW, PLTW, NVDW. So basically, think about leveraged high-yield income ETFs. Now, previously, I was so highly invested allocation-wise into HOOW, for instance. So anytime there was any dramatic movement with just that ETF, my whole portfolio went like berserk on me. So in order to mitigate this, I have decided if it's going to be a leveraged fund, I'm going to do my best to limit it at a max of 10% allocation. So I think this may be a better fit, and I'll break down the positions that I'm looking at soon, but the last 10%, guys, my internet has been going crazy today. So I actually changed all this previously and it reset because the internet disconnected. But this is going to kind of be like my mystery allocation. I'm not really sure what I'm going to be doing with it, but that's kind of what I'm looking at right now. So now we're going to dive into my Dividend Nomad sheet. This is a sheet I created, and this is my contribution or allocation calculator. So I put in all the positions that I'm interested in, and as you can see, I left this spot blank, and I'll explain why. So I have been playing around with this as a reference, and I was looking at the possibility of trying to get paid every single day, but I wanted to also pick funds that I personally liked. So of course, if there wasn't a fund that I wanted to invest into, then I didn't prioritize finding a fund to pay for that day, okay? But as you can see, they have funds listed here that pay Monday, Tuesday, Wednesday, Thursday, Friday. I'm not sure if there's more than what's included on this list, but this is just like an image that I referenced. As you guys can see, I have my contribution amount over here, and then I have like the allocation distribution, and then I have, you know, once I enter into these positions, it'll show how many shares I have, which will pull from the positions sheet here. And then it'll also show the average cost per share, that again pulled from the positions tab. And then it'll show how much equity I have, what my current allocation percentage is, what my target allocation percentage is, and the gap. So this will help me figure out, do I need to invest or do I want to invest into this position? Will it leave me overexposed or not? Or do I need to rebalance things, right? And by rebalancing things, I don't mean selling to increase position in another one, but more so like next time I contribute any funds, I will focus on the funds that are underneath the target allocation percentage. Hope this all makes sense. I'm still gathering my thoughts around this, and so I'm not super cohesive with it yet. Now these colors each represent a day. So for instance, this color is for Monday. This color here, this blue, light blue color is for Tuesday. This orangish color is for Wednesday. this purplish color for Thursday, and this yellow color for Friday. So currently, these are the funds that I am looking into. HOW, of course, NVDW, PLTW, WPAY, CHPY, QDTE, and KQQQ. Now you notice KQQQ is left the traditional color of this sheet. And the reason why is because it's a monthly pair. So I'm not really including it within this whole Monday, Wednesday, Tuesday, Thursday, Friday strategy. These are the allocations that I'm thinking. So again, like I mentioned, 10% allocation or portfolio diversity for these positions. So I don't want these ones in particular to, based on contribution amount, outgrow these allocation goals that I have set. And the reason why is because if HOW goes down, for instance, but NVDW and PLTW are doing okay, because my allocation at HOW is only 10% and these other two combined are 20%, it should offset. That's at least my mindset and my goal. This is not a bad strategy. However, of course, I'm still new here. I'm still learning, and TBD, to be determined. But then I also have a 30% allocation into something like CHPY, which has had a pretty stable NAV and some growth on its chart. So I think this is also a pretty good contender. And then there's QDTE. Again, it's fairly stable. And because, again, these are making up a bigger percentage of the portfolio, I think it should offset any potential pullbacks, any potential corrections. But this is currently what the allocations I am considering are. And yeah, I may be spreading myself too thin considering how small my portfolio is, but I'd like to think that this is a relatively goodish strategy. So with my current portfolio amount, which I'll get into my portfolio in a second. So I have $5,538.27 in cash sitting in my account right now. That breaks down to these numbers. If I were to invest by dollar amounts, that is the goal. That is the strategy. Maybe I am being overly optimistic, but I don't know. What do you guys think? Comment down below. What do you think about this new approach, this new strategy that I'm doing? Is there anything I should tweak? Anything you think I should change? Now, diving into the portfolio. Again, I'm sitting on cash. My portfolio is at $5,538.27, which is also all my cash. I have not used any margin right now, but my margin total is $7,589.67. So in total, my buying power is $13,127.94. So that's what I could use if I wanted to. I'm not saying I'm going to, but that's just hypothetically what I could do. And real quick, this is how my portfolio would be doing if I held it. So I'd be down, just from HOW, I'd be down 14.10% market return. Now, of course, that's not my total return because of the dividends that I got, but that's brutal. That's brutal on my capital. And to be honest, I don't always want to look at total return percentage as like my only metric, right? Like I look at both. Both are very important to me. I want market return to stay fairly healthy, and I also want my total return to be incredible. Now, obviously, if my market return is like negative 14, but my total return was like 30%, 40%, okay, I don't care. But of course, in this scenario, my market return is negative 14% and my total return is negative 7%. So I'm at a 7%-ish loss. Technically a little bit less than that, but you guys get the point. WPAY would be down 7.86%. NVDW would only be down like 0.40%, so nothing too crazy. Again, I sold KQQQ, and that was probably not a smart decision at the time. I was panicking. I'll be honest, guys. I'm not ashamed of it. And then PLTW would be down like negative 5%, but that's okay because I hadn't really gone like all the way into my PLTW position. I was slowly starting to grow that. But as you can see, look, like HOW was 23.56% portfolio allocation, and then WPAY was 49.2%. That made up a majority of my positions. And again, like these two were down so bad that it's just dragging me down. Enough about that. You guys get the point. I don't want to keep beating a dead horse. This is my X account. If you guys aren't following me, make sure to shoot a follow for me. My goal is to get to 100 followers this month. Basically, I post all my updates. You know, I posted when I sold, talk about when I purchased positions, my opinions on certain funds, distributions, and anything that pertains to the market, really. I like to keep it just focused on that. But yeah, if you guys give me a follow, that would mean so much. It's at I'm Nomad Investor. Again, at I'm Nomad Investor on X. Now, diving into this is from Wanna Be Fresh, Richie B. He said, Monday morning huddle, recap. Markets ended last week under pressure, and the pre-market this morning isn't offering relief. Futures are down, and sentiment remains fragile. The ongoing temporary government reopening process is continuing to weigh on data flow and confidence. What to watch today? Testimony or remarks from any Fed regional president, even small ones, any hint on rate path. Oil inventories and labor-related data, even thin reports with the shutdown, numbers could surprise. Tech earnings early in the week. A weak show could amplify the pullback. Cough, Nvidia. Markets reaction to China/trade headlines. Trade risk is still alive. I completely agree with that. Chart takeaways and mindset. Key support levels for major indexes are being tested. If they break, we risk a deeper leg down. Watch for volume spikes on down days. That's a bad sign. Mindset, expect a fight. Don't rely on a smooth bounce. If you're trading or investing this week, focus more on risk management than aggressive entries. This is why I said I'm going to ease my way into these positions, is because I personally have learned the hard way. Because I am someone who has aggressively entered into positions or aggressively DCA'd when instead I should do small amounts at a time. And then a reminder, volatility is expected, but emotional reactions cost more than price swings. This is true. This is why I experienced a -1. This is why I went through a $1,100 loss. And then final thoughts. Today might give us early clues on how this week plays out. A decent open could calm some nerves, but any shock, data, policy, trade can flip the script fast. Be ready to adjust quickly, hold capital, and move when your edge is clear, not when you feel you should. We're in for a bumpy ride. Like I've been saying these past few weeks, it's never a bad move to play a little defense and hoard some cash in case this drawdown keeps stretching. Happy Monday, fam. Then there's another one that I wanted to cover by him. This is in response to the Monday morning huddle. It says, the market is absolutely brutal right now. And the part that's throwing me off is how little rationale there is behind the drop. We've had sell-offs before where the reason was obvious. Tariffs, poor data, government shutdown complications, uncertainty in rate cuts, etc. This one doesn't fully add up, which is a bit telling to me. When selling gets this exaggerated without a clear catalyst, it usually means fear is doing more work than fundamentals. And as ugly as that feels in a moment, it's also the type of environment that sparks some of the strongest rallies. Will we chop for a bit? Probably. Charts are ugly, and there's nothing that I can see in terms of sentiment that can provide a sharp V leading into an extended period of green in the short term. Could it stay ugly for a week or two? Of course. But stretches like this also burn off the weak hands, reset the overextended charts, and set up the next leg higher when sentiment flips. Unfortunately, guys, I guess I had weak hands. I mean, not I guess. Obviously, I did. But I'm learning. I'm learning, guys. And then it says, maybe it's a little bit of a blind optimism, but it's my understanding how markets typically work in years past. Pain doesn't last forever. Sentiment always swings back. If you're managing risk, staying patient, and keeping your head straight, there's always a reason to have hope. Until then, we have no choice but to weather the storm. Last, I wanted to quote this. He said, this information is super important, so here's my attempt to decipher this in simpler terms in hopes people can understand this better. Now, he's quoting the KBC. I don't know how to pronounce this, but the KBC letter, I think it's called. It was really cool to see him break this down in a much simpler way. So he said, the global economy is basically a giant bathtub. Right now, every major country is dumping water into it at the same time. The US with the $2,000 stimulus checks, Japan $110 billion package, China $1.4 trillion package, Fed ending quantitative tightening, US issuing $1.9 trillion in treasuries, Canada restarting quantitative easing, global M2 at record highs, 320 plus rate cuts worldwide. If every country is dumping water into the same bathtub and nobody is letting the water drain out, then the water level, inflation, only has one direction to go, up. That's the simplest explanation of why another inflation wave is extremely likely. Things can change, but this is the current reading around the world. So I think that's something very interesting to take into consideration. I actually didn't see the KBC letter of this one today until I saw that Richie B reposted it or shared it. And I love that he kind of covered this because, to be honest, I haven't been paying much attention to Japan or China. Obviously, I knew about the Fed ending the quantitative tightening, and I wasn't really aware about the issuing of 1.9 trillion in treasuries. Also, I had no idea about Canada and the 320 plus rate cuts worldwide. So this is all really good stuff to know. And yeah, I mean, Inflation going up is, I think, a given at this point. Another post that I wanted to share is from Rex Shares. It says US market events this week. Monday, federal budget balance for October, 6-month bill auction. Tuesday, industrial production, API weekly crude oil stock. Wednesday, crude oil inventories, building permits, FOMC meeting minutes, and Nvidia earnings. This is the one that I'm waiting for. Thursday, unemployment rate, existing home sales, initial jobless claims, non-farm payrolls. And then Friday, S&P Global Services PMI, S&P Global Manufacturing PMI, US Baker Hughes oil rig count, and average hourly earnings. So these are all things you guys need to be prepared for this week. Now, like I mentioned, WPAY did release their newest distribution. They dropped it, which I'm actually okay with. They dropped it down to 39 cents a share. And for me, that's actually a very healthy thing to do. Considering that it's dipped below its launch price, in order to preserve the NAV, they need to reduce the distribution that gets paid out. So even though it's dipped below the 50 cents a share, which I always talk about, I'm pretty happy with this amount. And I approve it because I believe that WPAY, once we get back to more of a bull run or rally of some kind, will move in a more positive direction, and we should see it go back above, and this is my speculation by the way, but we should see it go back above its launch price, hopefully more, and from there, if you were able to buy this dip, you would be in a very, very good situation. And then last, I wanted to quickly break this down from Mont Blanc Research. It says, Nvidia earnings are on Wednesday. Nvidia is expected to report $54 billion in revenue and 1.25 in EPS, backed by booming AI demand. Remember, the bar is set high, so anything less or weak forward guidance could hurt. But a strong beat and upbeat outlook could spark the next move. And so this is a really interesting graph. It says 5 trillion. How big is Nvidia? Nvidia's market capitalization in comparison to the combined market cap of other companies. So Meta and Google combined would equal the market capitalization of Nvidia. And then obviously you see Apple here. It's kind of close, but not enough. And then Costco, Walmart, and Amazon combined are close enough to Apple, but still not quite at Nvidia's level. Then there's Microsoft and so on and so on. So I think this is a really interesting graph. And I hope you guys are able to kind of like visually see now how much, just like the Mag 7, for instance, rely on Nvidia. It's insane. Hopping over here into Yahoo Finance, we got some headlines such as the stocks wobble as Wall Street looks ahead to Nvidia data releases. There's another one I want to cover, which is Peter Thiel's fund sold off entire Nvidia stake in Q3. So we're obviously in Q4 now, but last quarter, Peter Thiel's fund, I think it's called SoftBank, sold it all off. But I wanted to dive into the futures. So for S&P 500, it's in the green, 0.09%. The Dow is down 0.04%. NASDAQ is down 0.32%. Russell is down 0.41%. The VIX is up 5.85% today. And gold is down 0.75%. So yeah, it's looking like a pretty red-ish day. Not like severely red, but some red. And now I wanted to hop into here real quick. I was wanting to show you guys like how personally like I typically look at funds in terms of when I'm personally want to invest into them. So again, this is just like a quick lesson of what you could do to like do your own research, okay? I'm not telling you to invest in these positions. I'm just using them as an example. And this is stock analysis, by the way. You can hop into a position and then like search like HOW, click on that. And then there's like a button that says compare funds. And then you can kind of like search different ETFs and compare them, okay? Anyways, hopping over here, you go down to the comparison section underneath the chart. You click price, and you can see the 52-week low and the 52-week high. And you can actually see how much of a percentage difference is it from the 52-week high and also the 52-week low. So what's cool here is if I, for instance, am looking into investing into HOW or any of these funds, I can kind of put them all in this comparison, and I can take a look and say, okay, cool. This is not a bad entry for HOW or whatever fund that I'm looking at because it's down 36.54% from its 52-week high. So I'm not buying the top, for instance. And then if I want to get a little bit more granular, I could also take a look and see, okay, well, how far is it from its 52-week low? Oh, it's only 9.36% above. So that's actually a really good spot to get in my opinion. And that's how I've been doing my typical due diligence, my research before investing into funds. Now, of course, previously I got emotional, and rather than do my typical research, which I like to do, I just like invested at the time. And again, just a friendly reminder for those who bashed on me for dropping blocks so quickly. Yeah, it's down negative 32.54% from its 52-week high. And if you guys remember, I bought pretty freaking close to its 52-week high, so I'd be down so bad on it, as well as I was down with HOW. So I have no regrets. Anyways, that's how I've done my research on entries. Anyways, guys, I hope you really enjoyed today's video. I know it wasn't really like showing positions that I'm currently invested into, but I'm at least sharing with you guys my game plan and strategy moving forward. And I hope you guys may have learned something from this, or at least got entertained from it. I don't know. Is there anything you guys recommend I should do differently? If so, comment down below. I'd love to hear any comments, questions, suggestions, or feedback. If you haven't already, smash that subscribe button. It really does help me stay motivated to continue making these videos. And most importantly, smash that like button. It goes a long way and helps with the YouTube algorithm. Until next time, guys, peace.